With the Bank of Canada's recent announcement to increase the overnight lending rate, there's going to be a term that you're going to start hearing a lot more frequently if you haven't already, and that's called a trigger rate. What a trigger rate is where the bank will automatically increase your mortgage payments to cover a shortfall. And here's what that essentially means. If you have a variable rate mortgage, chances are that when you got that mortgage, you locked it in based on the rate at that time and with a fixed payment. So what that means is whatever your monthly payment was when you signed up for that variable rate mortgage, that would be the amount that you'd be paying monthly for the duration of that mortgage term, regardless if the overnight lending rate went up or down. Now, in a regular market, that doesn't make much of a big impact. The rate might go up 0.25 or 0.5% or down the other way. So really, it doesn't have that much impact on either you or the bank. But since January, the Bank of Canada has increased their lending rate by 3%, meaning that most variable mortgages have gone up in 3%. Unfortunately, the media doesn't talk about this, but as a consumer, you really need to know what that means for you, particularly if you have a fixed payment. Take this for example. If you had a mortgage at $500,000 and you initially signed your mortgage at 1.5%, which was the variable rate at the time, or that's what your payment was based on, that would mean you're paying $1,998.59 a month. That rate or payment would stay the same for the duration of the term of your variable rate mortgage, regardless of what the underlying rate is. A lot of consumers opt to do this because it provides a level of security in knowing your payments aren't going to change, and I would agree with that in normal circumstances. But let's take what it's like now. The Bank of Canada has increased their lending rate by 3% this year. So assuming you had that 1.5% and that payment of just under $2,000, now your interest rate is 4.5%. To put it in perspective, that same $500,000 mortgage at 4.5% would be a payment of $2,767.37. Of that, $1,857.66 is interest. Now, that is what your mortgage is based on. So when you're looking at it right now, assuming that same $500,000 mortgage variable, even though your payment is still just under $2,000, the interest component of it is almost $1,900. That would mean it would take you almost 59 years to pay off a mortgage that you think is going to be paid off in 25 years. And it's a shame that a lot of consumers don't know about this. So what you really need to do is contact the bank or your mortgage professional and find out, what is my trigger rate? Basically, when is my payment going to go up? Or you could be proactive about it and automatically start increasing your payment. Don't pretend like this is not happening right now, because if you don't get on top of this, it's going to affect your financial future and probably your financial well-being in the not too distant future. Because to think that your payments are just covering interest is insane. And you could put your money towards that mortgage instead of maybe investing in other things. Start paying your mortgage down a little bit more. At the current variable rates, it's honestly probably a better return than you're going to get in your stocks or other investments, and you pay your mortgage with after-tax dollars. So there's definitely things that you can be doing and you should be doing. But please, if you have a variable rate mortgage with a fixed payment amount, you need to get in touch with your financial advisor and see what you could do to make sure that you're staying on track to your financial freedom. As always, we're available to talk or discuss any questions that you might have and lead you in the right direction or navigate you to the best professional for your personal situation. And you can contact us in the information below.